Hello and welcome to Tax File. I am your host, Laure Bala Hassan, and I'm excited to guide you through another insightful episode. We begin with the latest tax headlines, giving you a clear sense of what's new and what matters. Our Did You Know segment follows where we share eye-opening tax tips and interesting facts you may not have heard before. Then it's time for our Vox Pop. We step outside the studio to listen to everyday voices and real perspectives from the public. After that, we break things down in the knowledge zone, helping you understand the issues behind those opinions. Our Professional Insight segment also brings expert explanations that simplify complex tax topics. And to wrap the sequence, What's on the Net spotlights your comments, questions, and reactions from across our online platforms. There's so much ahead. Let's jump right in. And now, the news. The Nigeria Revenue Service, NRS, formerly Federal Inland Revenue Service, FIRS, says Nigeria's new tax laws are built to enhance economic competitiveness, attract fresh investment, and support long-term fiscal stability. The agency also clarified that 4% development levy on imported goods is not a new tax, but a streamlined consolidation of several existing charges. Aisha Bilkader reports.
According to the NRS, the levy replaces multiple fragmented payments, including the Tertiary Education Tax, NIDDA levy, Naseni levy, and the Police Trust Fund levy, thereby reducing compliance costs for businesses and putting an end to numerous overlapping levies imposed by different agencies. The reforms also shield small businesses and non-resident companies from the charge, ensuring that the most vulnerable enterprises are not burdened. Analysts say the simplified levy structure sends a strong signal that Nigeria is moving towards a more coordinated, transparent, and investor-friendly tax environment. Concerns had also been raised about the future of free trade zones under the new laws. But the NRS clarified that the long-standing tax-exempt status of FTZ operators remain intact. The reforms, it says, simply introduce clearer operational guidelines to strengthen governance and preserve the zone's original purpose.
The Presidential Fiscal Policy and Tax Reforms Committee has announced the selection of 20 Nigerian digital content creators who will undergo a special training program aimed at improving public understanding of the country's new tax laws. The shortlisting came after a public nomination exercise that garnered 8,591 submissions for over 200 creators. Evelyn Shija has that report.
The selected creators, chosen based on the size of their combined followership across major social media platforms such as YouTube, TikTok, Instagram, Facebook, and X, the training under the program titled Influencing for Good is intended to equip them with accurate, balanced, and clear knowledge of the new tax reforms so that they can educate and inform their followers. The initiative reflects a broader push by the government to boost tax literacy and ensure citizens get reliable information about the reform's implications.
With the commencement of the new tax regime, business owners, particularly small and medium-sized enterprises (SMEs), are voicing significant concerns over potential harassment and illegal levies. Top government officials have moved to reassure the business community, emphasizing that reforms are designed to eliminate, not encourage, abusive practices. Ejura Etu Opanachi reports.
The chairman of the Presidential Committee on Fiscal Policy and Tax Reforms, Mr. Taiwo Oyedele, firmly stated that the new Nigeria Tax Administration Act, NTTA 2025, prohibits multiple taxation and unauthorized levies. He clarified that local governments lose the power to randomly stop businesses or vehicles for tax collection, mandating that all taxes be paid through clear, digital, and traceable channels. Any official demanding cash, or acting outside the law will face sanctions for extortion. Executive Chairman of Nigeria Revenue Service (NRS) Zak Adedeji reinforced this position, stressing that the reform marks a shift to voluntary compliance built on trust and clarity. He warned against the incorrect application of the new rules, such as wrongful withholding tax deductions, and confirmed that the NRS is deploying technology for transparency, ensuring payments are verifiable with no room for cash collection. Both officials stated their commitment to sustained engagement and taxpayer education to ensure full understanding of the new obligations and protections, especially for small businesses.
And that wraps up the news. Let's now join Mariam on the Vox Pop segment.
Hello and welcome to the segment. My name is Mariam Julde Adura, and today we're at the Unity Roundabout in Yola. We will be finding out what happens to a company that fails to keep the proper records under the new tax law. Come. Under the new tax law, what are the penalties if a company fails to keep proper records?
If a company fails to keep proper records under the new tax law, effective January 2026, there's a penalty of 50,000 naira. And to avoid these penalties, companies should ensure they keep proper and up-to-date records.
Okay, so is this irrespective of companies who are exempt from paying taxes?
Yes, this is irrespective of companies who are exempted from paying taxes. Small companies will not be required to pay taxes going into 2026.
But they will need to keep their proper...
Oh, absolutely. They will need to keep proper records and file for their taxes.
Any company that fails to keep proper record will be charged administrative penalty of 50,000 naira.
The new tax law stated that starting from 2026, any company that fails to keep proper book will face a penalty of 50,000 naira.
Under the new tax law, effective 2026, any company who fails to keep proper book record is liable to pay an administrative penalty of 50,000 naira. Whether that company is exempted from paying tax or not is expected to file returns and keep proper book record. If not, they will be penalized.
What happens to a company who fails to keep the proper records under the new tax law?
Records are meant to be kept by companies in a manner where it's easily accessible for filing and assessment. However, if those records are not kept, then it's tantamount to breach. There is an administrative fine of 50,000 naira, among other penalties. And you also risk higher chances of audit, which would have much greater scrutiny of your activities and records.
Under the new tax law, any company that fails to keep proper records should pay a penalty of 50,000 naira, either small or large company. So that it helps them to do their annual returns.
Any company who fails to keep books records under the new tax law 2026 must pay a penalty, administrative penalty of 50,000 naira. And under the new tax law, any company who fails to keep record is at risk of facing the penalty and consequences. And to avoid these consequences, companies must prioritize in maintaining accurate and up-to-date financial records. Yes.
Did you know it is mandatory for businesses to maintain proper accounts, books, and records that allow for the correct determination and filing of tax liabilities? For more information, visit www.nrs.gov.ng.
Ashu Abe takes us on the Knowledge Zone.
Hello and welcome to Knowledge Zone, where we dive deeper into interesting conversations had on the streets. I remain your host, Ashu Abe. On today's episode, we'll be talking about what happens if a company fails to keep proper books under the new tax law. The Act makes it mandatory for businesses to maintain proper accounts, books, and records that allow for the correct determination and filing of tax liabilities. If a company fails to keep such books or provide them when requested by the relevant tax authority, it will incur an administrative penalty. For companies specifically, the penalty for failure to keep proper books is 50,000 naira, reflecting a higher compliance expectation for corporate entities compared to individual taxpayers. This requirement and its associated penalty are intended to ensure that the tax authorities can verify tax positions and assess liabilities accurately. Failure to comply hinders transparency and can delay audits or assessments. Therefore, small businesses and large corporations alike must implement reliable record-keeping systems to avoid these fines and to support accurate tax filing under the new law. Over to you, Lore.
And now to our Professional Insight segment.
Yeah, there's been some concerns, and when for every new thing, definitely there's going to be some level of concern. They say one thing that is constant in life is change. So when Nigeria is reforming, the first thing is people to understand why reforms. Reform means that there is a form, and people felt that form was not good, or we've all agreed that that form was not good enough. So what we need to do is to reform. And reform means there's going to be a new shape. And forming a new shape, there's going to be some level of panel beating, which means some people there's going to be some level of pinching, denting, pain, and there's going to be a level, a breath of fresh air for a lot of people. But by and large, what do we have? That breath of fresh air is supposed to be the major aspect. And so when we talk about tax reform, this tax reform has now come to what? Simplify the tax system, harmonize fragmented tax system that we have, also provide simple rules, clarity, coherence, and also update our tax system with what applies world over and in line with present realities. We had laws that have been archaic, laws of 1939 that has been still applied today. And so the tax reform came to change that. Now, if people have been used to that before now, changing that will mean that they need to change themselves. They need to change the way they do business, the way they pay taxes. They need to change the way they report in some instances. And of course, people don't like those changes. Let me go specifically. Lack of understanding also can be the result. Looking at those who have been raising concerns, some are actually genuine, and some have even come from quarters where we consider as experts in the field. But we also need to what is the context for every information that comes out, or for every concern, there's also a context. Now, the context may be from the perspective of the person making that concern, because he may be affected one way, but he may be a stakeholder, while the majority of stakeholders can have better opportunity. Now, talking about specifically about the reforms. Before today, businesses with a threshold of 25 million are the ones exempt from tax, income tax now. But today in the new tax law, businesses with a turnover of 100 million are exempt. Is that not a good thing for Nigerians and for small businesses that can grow and thrive before they start paying taxes? Now, looking at the personal income, incomes of with a taxable income of 800,000 naira, which may probably be from an income of about 1.2 to 1.3 million, is asked to pay tax at 0%. And this is a good thing to reduce the tax burdens for Nigeria. We want to tax prosperity and not poverty. We want to tax the fruit and not the seed. And of course, for people who have been making so much fruits and little have been taxed over time. And now they may have to provide more, or they may have to be taxed a bit more for those who are in penury and poverty to be able to breathe. So they may raise some concern. So for me, and by and large, I think Nigerians should understand that the majority of Nigerians will benefit more in this tax reform. And those concerns that have been raised, I'm sure that we've been responding to them in many quarters. You watch interview by the chairman of the NRS, watch interview by the chairman of the Presidential Committee. Most of them have been dealt with. And I think we can move on and enjoy the implementation of the new reforms while people start getting the gains of the reform. Naturally, in taxation, you have obligations and rights. And so corporate entities definitely need to be more, to look at how to make their reporting better to ensure that they do not fall short of the law. So they need to look at the incentive management. They need to look at keeping their books properly. They need to keep their expenses well. They need to record their income appropriately. Classify their income, classify their expenses well. So it will help them to ease the burden of declaration and also explaining to the taxman. Now, corporate entities also have other obligations like declaring their tax planning schemes to the tax authority. So it do not go from era of planning to evasion. So we all know they say tax avoidance. Tax avoidance is allowed using the loopholes. We've seen that in recent time, people have moved to what we call aggressive tax avoidance, which mostly led to tax evasion. So before they skip into tax evasion, the law now mandates them to declare their tax avoidance scheme to the tax authority. And so corporate entities need to be more responsive and more responsible in their reporting. And so, and to review the laws adequately, develop their strategy, develop proper strategy that will make them comply appropriately. Now, we believe that tax is neutral. So the consideration for tax is when you have made profits. So when you make such profits, corporate entities should know that now they will pay tax. Now they should also consider those ease that the law has brought to them. The exemption of minimum tax. Now corporate entities need to know that now when they make a loss, they don't need to pay minimum tax. And for those large corporates, the multinational enterprises that are in scope for what we call the effective tax rate, when they have a global turnover of 750 million euro, they need to understand that there's a new regime for effective tax rate, which of 15%, upon which they will pay if their effective tax rate is not 15%. They may need to pay a top-up tax. So corporates, multinational enterprises, or constituted companies under a multinational enterprise need to understand this and know that this is a new obligation. Large companies, large corporates of turnover with turnover of 50 billion also have this obligation of the new effective tax rate. So they need to understand this in all their plans. Tax incentive, of course, there may be a reduction in tax burden for a tax. They are used as a way of compensating businesses or a way of mobilizing investments. And now there's been some level of change in the administration of tax incentive. One very big one, which many have used in the past, is called the pioneer status before now. Now, the pioneer status was just given a tax holiday between 3 to 5 years under the Companies Income Tax Act and Industrial Development Income Tax Relief Act. This provision have changed right now as there's a new dispensation under the Nigerian Tax Act, which is called the Economic Development Income Tax Incentive. And this grants tax credits to what we call the priority sectors, which governments would like to grow. So when we call them priority sector, they are listed in the law. And so this grants them 5% tax credits for 5 years, and which they can carry forward these credits for another period of 5 years before it's exhausted. Now, that's a major change in our incentive management. And so this is a big one for corporates, and many industries have been listed as priority sectors, which include the likes of power, those in power, in agriculture, in telecommunication, in renewable energy, and manufacturing, and all this is to boost economic development. So this is a major one we should look at in tax incentive.
Over now to Swateku for what's on the net.
Good day and welcome to What's on the Net. My name is Joyce Swateku. At Kekiawa is asking, please, how can a civil servant obtain his or her tax ID as a government worker? At Kekiawa, a civil servant can obtain a tax identification number TIN by registering through the Joint Tax Board platform or by visiting the State Internal Revenue Service where they are employed. In most cases, civil servants already have a TIN generated through their payee payroll system. If unsure, they are advised to verify their TIN with their employer or tax authority rather than applying for a new one. At Abdul Kudus is asking, what is the difference between the TIN and the payee ID? At Kudus, TIN, tax identification number, is issued to an individual or business and is used for all general tax matters, such as filing returns and official tax transactions. Payee ID, pay as you earn ID, is issued to employers and used specifically to deduct and remit employees' income taxes to the tax authority. In summary, TIN identifies the taxpayer, while payee ID is for employers handling staff taxes. Over to you, Laurie.
And that brings us to the end of this episode of Tax File. I hope you've gained clearer insight and learned something you can use in your day-to-day decisions. Stay connected with us online. Your thoughts, questions, and contributions keep the conversation alive. I am Laurie Bala Hassan. Until next time, stay knowledgeable, stay compliant, and keep watching Tax File.